Hi, we are Team 3, and we are dealing the mini case about hedging exchange risk method, especially the forward part. And these are our contents. And let's go on for the concepts first. The exchange risk refers to the losses that an international financial transaction may incur due to currency fluctuations. It describes the possibility that the value may decrease due to the changes in the relative value of the involved currency, which means that when a company engages in financial transactions denominated in a currency other than the currency where the company is based, and it is also called as currency risk, FX risk, and exchange rate risk. Then how we can manage this exchange risk? These are five methods listed in. First, the invoice. It is the way of arranging for the contract and the invoice to be in your own currency. It'll shift all exchange risk from you to other party. So that it means that the other party will get all the risk along with price and other payment terms. Second, the netting. It is offsetting of exposure in one type of currency with exposure in the same or another type of currency. It is usually carried out by large companies who deal with a huge number of international clients. And as it is not possible to hedge each and every client's currency risk individually, all currencies exposure should be managed as a single portfolio, which saves cost and time involved in hedging each currency risk. Third, the matching. It is dealing the exchange risk by opening a foreign currency bank account. So if you have the payment ongoing, you can reduce the exposed amount of risk. Next, the leading and lagging. Leading is conducting transaction in advance, and on the contrast, lagging is delaying the transaction. For example, if you deal with euro, you can erect leading when you believe euro will strengthen against your own currency, and if you know the euro is going to weaken, you will erect lagging. Lastly, the financial methods. Hedging exchange risk can be dealt with several instruments, such as forwards, futures, ETF, and options. Forward hedging is locking in a future currency sale or purchase and can therefore result in exchange risk losses if the exchange rate moves in the opposite direction from that expected. They can be customized to specific amounts and maturities. However, the drawback is that they are not readily accessible to individual investors. The futures are used by trading on an exchange and need only a small amount of upfront margin. However, it cannot be customized and are only available for fixed dates. ETF are suitable to hedge risk for individual investors in the sense that it can be traded on the long or short side. Options give trader the right to buy or sell a specific currency in a specific amount on or before the expiration date at the strike price. Therefore, it can protect a business from adverse exchange rate movements while still allowing it to benefit from favorable ones. Exchange risk cannot be avoided altogether, but it can still be mitigated considerably through the use of managing techniques. And here we're dealing the case about forward hedging method.
Hi, my name is Chongho Park, and I'm going to talk about the mini case. So let me see the problem first. So we can see the current situation. Now, the current spot rate for pound per euro is 1 euro per 1.4537 euro. So we have accounts receivable for 465,184 euro. So it would be the accounts receivable for 320,000 pounds. So let's assume 3 months later, if the pound is appreciated, like £1 per 1.5 euro, so that account receivable for this amount would be like account receivable for 310,123 pound, which is the 9,877 pound loss. So we can say it has a risk of pound appreciation. Next, please. So let's see the banker's suggestion. Banker suggested like sell euro receivable for pound based on the euro per pound forward cross exchange rate. So let's think about the euro per pound forward exchange rate for 3 months. We have now 3 months forward dollar per pound rate and dollar per euro rate in here. So if you're gonna get the 3 months forward euro per pound rate, we can turn upside down the dollar per euro rate and multiply it by the dollar per pound rate like this. So we can have the exchange rate like 1.4437 euro per 1 pound. So like this, if we just forward hedge like this, we can have accounts receivable 465,184 euro now, and we can sell it for dollar. So we can have a receivable for $611,903. So, and if we buy the pound using this dollar, we can have a receivable for 322,224 pounds. Next, please. So in here, through this contract, Mr. Pictus can get 322,224 pounds minus 320,000 pounds. So Mr. Pictus can get 2,224 pound arbitrage profit. Then let's assume 3 months later, if the pound is appreciated like 1 pound per 1.5 euro, in original contract, Mr. Peters will get 9,877 pound loss. And in forward contract, Mr. Peters will get 1.5 euro minus 1.4537 euro multiplied by 322,224. So we can get 14,919 euro. It will be, which is the 9,946 profit. And if the pound is depreciated like this, if we just calculate this and apply the same equation, we can get a 12,274 pound profit and 12,359 pound loss. So we can see here, or compared to the arbitrage profit, the profit or loss according to the pound appreciation or depreciation is a bit trivial. So Mr. Peters can get the risk-free profit if we just follow the banker's suggestion. So the answer should be that Mr. Peters should accept the banker's suggestion. And next, we will see the real case of this kind of situation.
Hi, I'm the third presenter, Do-kyung Kim, and from now on, I would like to give an example where forward exchange trading is specifically applied to industry. Fluctuations in exchange rates are not welcome for domestic companies that operate mainly on exports rather than domestic demand. In particular, the shipbuilding industry is regarded as one of the industries with the largest changes in performance due to exchange rate fluctuation. It is vulnerable because payments are received from overseas shipping companies in a heavy tail method after a considerable period of time. The heavy tail method refers to a method that receives 10 to 20% of the total price as advance payment when receiving a ship order and the balance received when delivering the ship. Shipbuilding companies trade derivatives, especially future exchange sales contracts with domestic financial institutions to avoid the risk of exchange rate fluctuation. The reason why shipbuilders give up expected profits from exchange rate changes and sign derivatives is that the exchange rate until delivery of the ship is unpredictable. For example, if the $1 exchange is 1,000 won per dollar and the company receives an order amount of $100 million, the company signs a forward exchange contract to fix the won conversion amount. In this case, whether the exchange rate surges to 1,400 won or falls to 900 won, the won denominated order amount is confirmed at 100 billion won. Last year, 3 domestic shipbuilders signed a contract for 103 liquefied natural gas carriers with a worth of Korean won 23.6 trillion Korean won from Qatar Petroleum. If the contract was signed on March 19, when the $1 exchange was the highest last year, the price of one LNG carrier would be about 229 billion won. However, if the contract was signed at the exchange rate as of December, the price per LNG carrier is about 192 billion won. This is a decrease of 37 billion won from the peak. The proportion of currency hedging varies by shipbuilding companies. Samsung Heavy Industries hedges 100% on foreign exchange inflows and outflows, while Hyundai Heavy Industries is 60%. Daewoo is hedging currency for 60% of the amount of the order, excluding 20% of the material cost. If the exchange rate declines like last year, Losses are inevitable for shipbuilders except for Samsung, which has 100%.
Lastly, my name is Jop Feijen and I'm the last speaker of this presentation. And in addition to the previous speakers, I will give another example of forward exchange trading. As stated before, forward exchange hedging strategies are used by many businesses to protect either the value of their cash flows, assets, or liabilities from big fluctuations in the exchange rate. This especially applies to international trading companies, obviously. In the last example, we took a look at the shipbuilding industry. In the upcoming example, a currency forward, which is a binding contract in the foreign exchange market, could make sure that in the last example, Samsung was the only one who did not lose money as a result of the changing exchange rate. However, forward exchange trading to protect your own cash flows and assets is normal in many industries. As is shown in the end of 2015 in November, the euro was close to a 6-month low when being compared to the US dollar, while other currencies around the world were also declining. This is shown on the graph on the right side of the screen. It shows that in November 2015, the exchange rate was $1.07 per euro. The declining currencies was a big problem for global law firms with their headquarters in the United States. In the Citibank private law firm group reported in the third quarter report that the currency fluctuations were exacerbating the revenue declines that law firms with large overseas operations, particularly in Europe, were experiencing. On the expense side, it helped the law firms with reducing costs, but it was not enough to counter the impact on the revenue side. CFO Paul Eichelman of Baker & McKenzie said that it's normal for their basket of currencies to go up and down. But during 2015, all of the currencies moved in the same direction when compared to the US dollar. This was a big strain for law firms. Hence why they were talking about currency hedging techniques that could be very interesting at this point. Next slide, please. If you take a look at the graph in this slide, we see the decrease in the exchange rate from euro dollar from May 2008 to January 2017. On the last graph on the last slide, we saw that at one point there was a very low point in November 2015 with $1.07. At this point in April 2014, like 6 months earlier, and the rate is a lot higher. It's $1.38 per euro. For your reference, the current rate as of March 2021 is $1.2 a euro. If we run some numbers, we can see if we run some numbers and pretend some of those law firm hedged a trade for 100 million euros in April 2014, they would have a worth of $138 million, which would be $31 million more than in November 2015. So if they would have hedged at this moment in time in April 2014, they would have made another $31 million just by hedging. This was our presentation. Thank you all for listening, and we'll look forward to your reviews and tips.